And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. And, today we have a jam-packed show. Today we're going to be entitling our show More Roth, More Reward. Kind of a bit of a play on more risk, more reward. As a financial advisor and a fiduciary of over 2.5 decades, I can tell you that I don't know that I've ever met a retiree who didn't wish that they had more Roth money. And when it comes to Roth IRA dollars, they're really, really nice. The programs are very simple. Anyone can have a Roth. Anyone can contribute to a Roth as long as they've got earned income. But the reality is that they're somewhat limited, right? And so many people feel as though they kind of got gypped on the whole Roth account, because when the government first came forward and said, hey, we've got this special retirement savings program called the Roth IRA, well, quite honestly, the way that they pitched it kind of made Americans a little bit skeptical as to whether or not it was actually really real. And so as a result, a lot of Americans did not initially contribute to the Roth. It took quite a long time before the Roth IRA kind of caught traction and actually started progressing and becoming more and more popular with up-and-coming retirees. But Roth money is indeed the best kind of money. And with the passage of the One Big Beautiful Bill, I believe that there's some maybe overlooked areas that could allow you the opportunity of being able to maybe put a lot of money aside into a Roth IRA. Now, if you've been kind of the normal person in America where the vast majority of your money is all pre-tax, maybe it's in your 401k, maybe it's in the 403b, this is going to be of particular importance today. So I really encourage you, stick around, have a pen and paper, and be able to make some notes. So you can go home or you can go back to whatever you're doing, and after the radio show, you can start to look at, from a mathematical standpoint, if you stand to benefit from some of the rules and regulations that are now the law of the land. Now, before we get into this, if you're new to this radio program, well, I just want to give you a very special welcome. If you've been looking for a radio show that's pretty down to earth, maybe at times a little bit controversial, maybe if you've been looking for an area where you can just become more naturally educated on what it's going to take to successfully retire. And by that, I mean having more income than what you need in retirement. Well, you've come to the right place. I'm Matthew Johnson. As a financial advisor and a fiduciary of over 2.5 decades, my number one goal is to help educate you on the universe of conservative income generating investments. Things that you can be investing in not only to give you diversification, to give you a better chance of weathering all of the things that can come at us as pre-retirees and retirees, but it can give you a better than average output of income. Income that you can spend without it coming at the expense of your principal. So let's get into this. What is this whole thing about more Roth, more reward? Well, as I was going through and just kind of sifting through the information about the One Big Beautiful Bill, and a lot of these things are just public knowledge now. This is something that's been publicized, I think, on every major news channel, every internet financial website has this information, so you can collaborate. And certainly, just to give you a disclaimer, I am not a CPA. I don't want to be a CPA, not intending to try to act like I'm a CPA. I have way too much personality for a CPA. Just joking, just joking. You don't have to send me hate mail over that one. But this is information that I think is easily sourced, and I think it's going to make sense to you. Number one, we know that during Trump's first administration, he worked really hard to try to increase the propensity of tax filers to just simply take and file their tax return using a standard deduction. Now, this is because you may remember, and it still does work this way, we have the capability of either taking and itemizing our taxes or just taking the standard deduction. Well, the reality is that when you itemize, you create a lot more work for, obviously, CPAs, for yourself, or accountants. You make a lot more work for the IRS. And so he was trying to simplify the tax process, and hence why he increased the standard deduction. Now, for 2025, the new standard deduction is going to be for a married couple filing jointly. It's going to be a staggering $31,500. Okay, that is a lot of standard deduction. Now, here's the thing: if you're over the age of 65, and we've known this has been the law of the land for a while. We know that you get another over age 65 deduction, and that over age 65 deduction was around $1,550. For 2025, it was being indexed upward to $1,600. So now, let's say that, again, you're married, you're filing jointly, you're going to have $1,600 if you're over the age of 65, and your spouse is going to have $1,600 if they're over the age of 65. That's $3,200 of additional tax deductibility. Now, does that come off from the $31,500? And the answer is no. It actually stacks on top of that $31,500. So that's pretty cool. But let's not stop there. What we want to do is we want to understand that there is a special tax deduction for those over the age of 65 for this year, and it sounds like the next 3 years, that's going to allow you to have up to $6,000 each of additional tax deductibility. So what this means is that you get the $31,500. If you're both over the age of 65, you obviously get the $1,600 times 2, that's $3,200. And then you get an extra $12,000 on top of that. So if you're able to make this work, if you don't have too much income coming in, you are going to be eligible for up to $46,700 worth of tax deductibility coming right off from your income. Now, this is part of the way in which the government is trying to reduce income taxation for you. But you know what? I don't want you to let this opportunity pass you by. So let's go back to some basics. We've talked about the Roth. What is so good about the Roth? Well, number one, the Roth IRA is excellent because it is affording us the opportunity of making gains. That could be capital appreciation, that could be interest, that could be dividends off from our money. And assuming that we meet the 5-year rule requirement for Roths, what it means is that all of the gains, all of the interest, all of the dividends will be totally tax-free. Now, that's a pretty good deal. And if I can set money aside in this Roth IRA and it can grow, it can compound over the course of time, it can participate with the market, it can earn 5, 6, 7% in interest and dividends over the course of time, and I can pull my gains out tax-free, that means not only can I take a lump sum of money out of my Roth IRA to go buy something or build something, I'm able to also use that Roth IRA money to create income for me, and that income would be totally tax-free. That's pretty cool. Now, here's the barrier to entry. Number one, when you think about what you can contribute to a Roth IRA. If you're over the age of 50, of course, you get a little bit of a catch-up provision. You can put now about $8,000 away in a Roth IRA, and that's nice. That's nice. But the reality is that if you're starting late in life and you really haven't had a lot of attention that you've been putting on Roth IRAs, that can feel like you're starting out at ground zero. And so a lot of people in this country who want to accelerate, they want to get more Roth money quicker, more immediately, they're going to turn to things called Roth conversions. Now, what is a Roth conversion? Well, I just want you to imagine that there's two 5-gallon buckets sitting on a table in front of you. And let's say that the bucket to the left, okay, this bucket over here, it's got $100,000 in it, and we're going to call this your pre-tax bucket, okay? This is money that's never had the taxes paid on it. It's never seen the light of day. And when you pull that money out of that bucket, whether you pull $1, you pull $100, you pull $10,000, it doesn't matter. You're going to be taxed on whatever you withdraw, okay? Then we've got the second bucket. Now, the second bucket, we're going to call that our Roth bucket, and that is empty. There is nothing in that bucket. Well, what is a Roth conversion? A Roth conversion is where we take money, we take a dollar amount, could be $500, could be $1,000, could be 10 grand, could be all $100,000, okay? And we're moving that money from the left bucket and we're putting it into the right bucket. Now, what is the advantage? Well, number one, let's be clear, that's going to be a taxable event. That's going to be taxable, okay? However, I want you to think about the long-term implication here. If, let's say, you don't need this money right away, and you're doing this because you want to have more Roth money and you want to have tax-free income down the road and you want to be able to have more tax-free money to draw a lump sum amount from to build something or to buy something. Well, think about the fact that the more money you have in that Roth bucket, the more things you can do without any tax implication. That's pretty nice. And so one of the things that's been such a barrier to entry for so many individuals has been the tax that is always required when we do a conversion. You see, if I take 10 grand out of my IRA bucket and I put it in my Roth bucket, I'm going to report that 10,000 as additional income and I'm going to pay taxes on it. But if you're starting to pick up what I'm laying down, if you are fitting the criteria based upon the big, beautiful bill, my friends, you may be able to have a lot more Roth conversion this year in 2025 and still pay next to nothing for taxes. Think about this. If we can deduct up to $46,700 from our income, think about the power of that. Think about how much more money you could have in your Roth accounts more quickly. Now sit tight. We're going to come back to this program. We're going to discuss even more so the implication of Roth conversions and why you need to be thinking about them. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining us, welcome to today's program. Today we're discussing more Roth, more reward. We kind of spent a good deal of the first half of the program discussing how it's always a good idea to have more tax-free income and tax-free money available to us when we're in the distribution stage of life, when we're retired. But you know what? For most of us, it's been a really long, grueling, expensive path to try to be able to get our Roth IRA money built up. Number one, you can only contribute so much every single year to a Roth. And I suppose if you started early, maybe you've got a leg up. But for most Americans didn't just come out and fully embrace the idea of the Roth account. They really felt as though the government was trying to do a bait and a switch. Well, turns out that the government wasn't. Turns out that the Roth is totally tax-free, and that's kind of a cool thing. And I think we've all kind of now acquiesced and accepted the fact that this is something that we can have access to. But if we are feeling behind, we know that there's really only one way that we're able to boost the amount of money that we have in our Roth IRA accounts, and that's by doing things called Roth conversions. But even though Roth conversions are unlimited, and we can do as much of a Roth conversion as we want, what is the one thing that holds people back from the Roth conversions? Well, really, in all honesty, there are two things. Number one And this is the big one. It's basically a taxable event. So if I've got $100,000 sitting in my IRA bucket and I want that $100,000 to be put into my Roth, and I move that full $100,000, well, guess what? I'm going to feel the sting of $100,000 of additional taxable income being put on top of the income that I've already earned or collected for the year. That could be very, very painful. Now, the second thing, and if you're not aware of this, you have to be, and keep in mind, you're going to need to consult with your own CPA, your own tax preparer, to make certain that this is true for you. But generally speaking, when I do a Roth conversion and I move money from that left bucket to that right bucket, I don't want to touch the gains off from that converted amount for a period of 5 years. Why? What happens if I convert 100,000, that 100,000 becomes 112,000, and I decide to pull that $12,000 out within the first 5 years? Well, what happens is you're going to lose the tax-free capabilities that the Roth IRA accounts afford you. So here's the thing. If you want to touch the original converted amount, the original 100,000, you can do that, no problem. But you don't want to touch the gains off from the converted amount for a period of 5 years. And that's important. So, you may be thinking, oh, well, I'm in retirement. I'm going to go ahead and I'm going to do this Roth conversion. Well, not so fast. You need to consult with a tax preparer. Make certain that that's a good idea, because you could be creating problems for yourself if you converted too much. Okay? Now, back to this whole idea. Why do I think that the big, beautiful bill is affording you more of an opportunity to Roth convert? Well, primarily because literally every standard deduction that we have had has been embellished. It's been increased, and it's not going to be something that lasts forever. From what I can understand, some of these things are only temporary for the next 3 years. So you're looking at things like the standard deduction going to $31,500 for a married couple filing jointly. You've got your normal over the age of 65 deduction of $1,600 times 2, that's $3,200. And now we're getting a special provision, kind of a bonus over age 65 deduction of $6,000 each. So again, if you're a married couple, that's an extra $12,000. That's going to give you up to $46,700 of tax deductibility. And you know what you could do with that? You could be doing Roth conversion. You could be taking Roth or funding, moving money from the IRA into the Roth and applying that towards that bigger standard deduction. And friends, that's something that may very well be worth your while. That's a big amount. And if this is something that's only going to last for maybe approximately the next 3 years, I encourage you to get with your CPA and check it out. Now, what's another thing? Well, I want you to think about this from an economic standpoint. Let's say that, you don't need this money for the next 5 years. And let's say that we're thinking about how you're currently invested. Okay? Let's just pretend for a moment that you're the normal average person that's still on the accumulation stage of your life. You're investing in, say, your mutual funds or your index funds, or maybe you've got stock and that sort of thing, because you're really focused on accumulation. You're focused on appreciation. Well, the Roth conversion is a wonderful thing, because especially if you're working with a fiduciary, you're working with someone who wants to do this for you properly the right way, which is what I consider to be journaling. Okay. And that's where you have, say, maybe 500 shares of Apple that's in your IRA, and you want to Roth convert a certain dollar amount. And so you take a certain number of shares of that Apple stock, and you don't sell them. You just simply move the shares into that Roth account. This is called journaling. You're just basically putting those shares into a different account, a different address. Okay. Now, when those shares move from that IRA account to that Roth account, that will trigger the taxable report. right? That will show that you took and you converted money from the IRA and put it into the Roth, and so you'll pay taxes on that, okay? But you never sold any of the shares. Now, why is this important? Because if we are dealing with a bullish market, if we are dealing with a market that is going to continue to trend higher, and I'm going to give some evidence as to why I think that that's likely going to be the case. The reality is that growth on those stocks, on those index funds, on whatever that asset may be, it could be gold, it could be silver, it could be any number, it could be pork bellies for all I care. That's going to be tax-free growth. Do you see how powerful that is? So if you could do more Roth conversion, because now you've got a bigger standard deduction, but you can also take advantage of where we are in the market, moving and journaling shares from that IRA into that Roth. If the market does continue to move onward and upward, it continues to progress the direction that you and I both want it to go. Well, that gain is tax-free when that money is sitting in the Roth. And see, here's the thing. We know, and I've discussed it on this radio show, it seems like there's a giant pissing match right now that's taking place between President Trump and the Federal Reserve, Mr. Jerome Powell. And it's ironic because President Trump is the one that appointed Jerome to the office, to the position. But the reality is that it's starting to get a little bit long in the tooth. We even now have a couple of Fed governors. We've got Christopher Waller, we've got Michelle Bowman, and they're both saying, listen, enough is enough. We need to start trimming interest rates. Okay? And I would agree. And folks, this is the reason, this is the exciting part here. This is the reason why we want to start thinking about doing Roth conversions right now. Now, I am highly, highly skeptical that we're going to get any kind of a interest rate cut in July. I don't think it's going to be possible. I think the Feds are just going to continue to suck their thumb and they're going to dig their heels in because they just don't feel the need to cut interest rates. They're going to go on recess, which is a great word, by the way, in August, but then they're going to come back in September. And I have a feeling by that time, the pressure will be so insurmountable that they're not going to have a choice. They're going to have to cut interest rates. Okay? And that at that point, we want to have already done our journaling. We want to have already have moved assets. The assets we felt that we could afford to pay the tax on. We've already checked it out with our tax preparer, our CPA. We've already gotten their blessing on this. And we have moved and journaled those assets into that Roth account. Friends, this is an opportunity. Is a Roth conversion right for you? I can't say. You're not my client. Okay, I'm not your fiduciary. I'm not your advisor. But I'm going to tell you from a philosophical standpoint, with the amount of tax deductibility that we have, with where we are economically with interest rates and the likelihood of the Federal Reserve taking and cutting interest rates later this year, with where the market is and where we probably have yet to go as far as growth and appreciation, if things continue to work out for an interest rate cut from the Feds, I would say this is one of the biggest opportunities that you will have had to improve your financial well-being. It's something that I want you to look into, something that I want you to be motivated behind, because we don't always get opportunities like this. And this is kind of the magic or the perfect storm. We've got interest rates still high. Things are still subdued in price. We've got bigger tax deductibility, which means we can move more money into that Roth. Well, let's do it, and let's do it now. Let's strike while the iron is hot. Let's make hay while the sun shines, so that by the time the Federal Reserve does cut interest rates, and let's say later this fall, we will have already rolled up our sleeves, done our work, moved our positions into that Roth account, and now we can sit back and we can enjoy the fruits of our labor. We can enjoy the tax-free growth of the assets going up in value tax-free, because the Federal Reserve has finally woken up, smelled the coffee, decided to actually take action and cut interest rates and help our nation and our businesses out for good. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it is up to you to make today a great day.